In this video, we're going to take a look at the maths behind the slow stochastic and how we can use this indicator to generate trading signals. Hello, I'm David Jones, and in this latest installment of the technical analysis course with Trading 212, I thought we'd stick with the subject of indicators again this week and take a look at the slow stochastic. Now, last time round, we took a look at the RSI, the Relative Strength Index, and that's perfectly fine, but I think maybe for some people, if you get an extreme move in the market, you get an extreme move maybe a bit too quickly in the RSI. So there is a way of trying to smooth out some of these signals, and one way is to use an indicator called the slow stochastic. The basic principles are pretty much the same. We have overbought, oversold, but we have arguably clearer signals, and as I said, it smooths out maybe some of the more extreme moves in the market. So to start off, before we look at it in the real world, let's just look at the maths behind the slow stochastic and how it gets calculated. Let's look at the maths behind this. Let's start off a 10-day stochastic. There are three things that go in: percentage K, percentage D, and percentage DN. Percentage K is the bit that does all the hard work. So this looks at the last 10 days, looks at the high and the low, looks at where the price is trading now, and expresses that as a percentage. If the market's traded between, let's say, 10 and 50 over the last 10 days, that's a 40-point range. If it's currently trading at 30, then it's halfway through the range, so percentage K would be 50%. But you never actually see this plotted on the chart. The two lines you see, which will be clear when we start looking at this on the chart, is a thing called percentage D. So percentage D is typically, it's a smoothed out version of percentage K. So if we're looking at a 10-day stochastic, percentage D tends to have a value of 6. So it's a 6-day moving average of percentage K. Okay, so that will smooth out this number here. Then percentage DN is, on a 10-day moving average, a 10-day stochastic, sorry, a 6-day moving average of percentage D. So just to put it simply, this is the bit that does the raw calculation, and then we see two smoothed out versions of that on the chart, and that's what generates the signals. So for a 10-day stochastic, it's 10, 6, 6, and the values for a 5-day stochastic, it's 5, 3, 3 tend to be the textbook values. Right, so there's the maths, simple enough, but don't worry about the maths because the trading platform obviously will draw the slow stochastic for you. So when we've got our stochastics on the chart, how do the signals get generated? First of all, let's take a look at the theory, and then we'll jump onto the platform and look at some real signals. So here's a badly drawn example of what it might look like. You can see why I'm not an artist. So we have the price here. This is what the price is doing. This is the market, whatever market it is. Then we have the percentage D line. Let's say this is a 10-day stochastic. So that will be our percentage D line with a value of 3. And then we have the percentage DN line, which is just a smoothed out version of that red line there. So using it simplistically, we have our overbought and oversold areas that we're maybe used to from things like the RSI. So that might be 70% and 30%. When the market goes below 30%, it's said to be oversold. We're expecting a bounce, but the signal comes from the percentage D line crossing through that DN line. So hopefully you can see that. We'll look at it in a real market in a minute. The sell signal comes when we go to the other extreme. We go above the 70% line here, and the stochastics hook lower. That would be our sell signal. And we also have this idea of divergence, which we've talked about before, where, for example, here the market pushes to a low, but our stochastics start trending up. That's known as bullish divergence, and can be a suggestion that maybe the weakness is running out of steam. And up here, we have the opposite of that, where the market pushes out to fresh highs, but our stochastics are falling. That's known as bearish divergence, so it can be a suggestion that maybe the market, the rally, is starting to lose some momentum, and it could be time to go short. So a couple of ways to use it: the simple crossover approach here, and also spotting these divergences where the market does one thing, but our stochastics are doing something else. Okay, so there's the theory, using the crossover in the extreme zones, but also this idea of divergence, which can be quite a powerful thing when we're looking at indicators. Let's see how this fares in the real world and take a look at a couple of markets and put slow stochastics on them. So let's take a look at this in the real world. We've got pound US dollar zero spread market up. This is a daily chart. Let's add our indicator. We can go to here, the indicators box, drop down menu, go to oscillators and scroll down. So we want slow stochastic oscillator. Click on that. I'm going to choose the 10, 6, 6. Click on confirm, and there we go. Our oscillator is added to the chart. Let's just scroll that up. So I've got 10, 6, 6. It's defaulted to 80% and 20% as overbought, oversold. You can change that if you want to, but let's just stick with what we've got. Let's just look at a couple of the simple signals here on this pound US dollar chart. So it's let's go back and look at the buy signal we had down here. So we have the percentage D line crossing above the red line. Our buy signal comes in there. That was back in August. The market rallies and we get a sell signal the other way. It worked pretty well, these two signals. Market declines, a buy signal in there. It gets a bit messy here, sort of halfway up the range for the stochastic. So no real signal there because it wasn't overbought or oversold. And the last signal we had on the 10-day stochastic was a sell signal here going back to the 4th of December. Let's change this to a 5-day stochastic and see what different signals we get. So I've changed this now to a 5-3-3 stochastic, and I've made the oversold area 30%, the overbought 70%. And you can see, because it's looking at a shorter period of time, 5 days rather than 10, we're getting many more signals. So we're getting a lot more volatility in the stochastic. And part of that, we will end up getting more false signals. The latest signal we're getting, just as I'm recording this, we're getting a sell signal here just the beginning of January for pound US dollar. We go back and we have a sell signal there, but it gets a little bit messy, I think, just in here. Sell signal there, buy signal down there, a sell signal up there, and so it goes on. We talked about this idea of divergence. We've got to go back, I think, to find the best example here, back to August 2017, where the market was declining. Our slow stochastics oversold, gave a buy signal, didn't work very well, but the market slipped lower. But look what our stochastics are doing. They're starting to trend up. Okay, so there's a suggestion here that maybe this weakness is running out of steam. The market has a couple of days where it pushes lower again, and eventually it does rally. But this setup here is bullish divergence. I think it's one of those things, it's always easier to spot in hindsight, but I think that's the best example on this chart here. Let's change the market and look at something else. I thought for a change, we'd take a look at the price of oil. So this is a daily chart of oil, currently trading around about $61 a barrel, just above it. And you can see we've had a clear trend since June 2017. So we're, 7 months into this trend now. So one approach could be, if we're selling in an uptrend, if we're taking the sell signals off stochastics in an uptrend, we're trading against that trend. So maybe the better approach is just look to be a buyer, take the signals in the direction of the trend. And we had probably the last true one when it dipped below oversold was back here, pretty good signal in November. Then we go back here, and here, and so it goes on. But you see there are plenty of sell signals that, I mean, some of them would have worked okay, but you just have to be a little bit wary of clearly trading against the trend. You know, if the trend is up, it doesn't really matter what the indicator is saying, that trend is still most definitely up. So maybe we use it as an opportunity to think about taking some profits rather than going short. And once again, on this example of divergence, we go back to here. August, the price of oil slips to a low, slips to about $46.50 a barrel. Stochastics are oversold, pushes a bit higher, slips lower still, but look at our bullish divergence. Okay, so again, a suggestion that maybe this weakness was running out of steam. We haven't really got a fantastic example of bearish divergence. I suppose we've got a little bit going on here. Market pushes to a high, pushes higher still, but the stochastics are falling. The price did fall off for about a week before that trend resumed. So that's where, I suppose that's not a bad example of bearish divergence, but I think this one here is the better one, the bullish divergence. So that's 5 day stochastics on the price of oil. We've been looking at daily charts here, but of course, if we flip this over to an hourly chart, we'll still have signals, But now, rather than looking at the last 5 days, we're looking at the last 5 hours. So again, if you want to use it on short-term charts, you can. The last signal we had was back here, this buy signal, which ended up being okay. But now it's looking at the last 5 hours. Okay, so you have much more signals with indicators and oscillators if you're using them on shorter-term charts. But overall, I think it hasn't done too bad on the two markets we looked at. It has helped to maybe smooth out some of the noise in those markets. So that was it in the real world, looking at overbought, oversold signals, the crossovers, and this idea of divergence. As I always say with these indicators, I think the problem is when you first start trading, you think there's a holy grail indicator out there, and if you can just find it, you're going to have untold wealth. The reality is it doesn't work that way. There's no magic system. There's no system that's right all the time. And I wouldn't say the slow stochastic is necessarily any better than the RSI, but it's all about finding an indicator that suits your particular style. So, try it out, maybe 5-day, a 10-day, maybe on an hourly chart if you want shorter term signals, and see if it fits with your trading approach. But for this week, we'll start wrapping things up. As usual, any questions or comments, or if you disagree, leave us a message in those comments down below. We do read all of them. If you like the video, click on the thumbs up, and we do lots of different videos, analysis of major currency pairs, oil and gold, jargon busting videos, all this stuff. There's a whole load of new content that goes up every week. So if you're not subscribed, if you click on the subscribe button there, and if you click, there's an alarm bell thing down there. If you make sure that's clicked, you'll get automatically notified every time we upload a new video. But for this week, with stochastics, we'll leave it there. So from me and Trading 212, I hope you have a good trading week.